Accounting rate of return, ARR. Process and calculation. The accounting rate of return, ARR, measures an investment's expected profitability as a percentage of average accounting profit relative to average or initial investment. The calculation process involves estimating annual accounting profits after depreciation and dividing them by the investment's average book value or initial cost. For example, ARR equals average annual profit divided by average investment times 100%. The method uses accounting data rather than cash flows, aligning closely with financial reporting measures. ARR provides an intuitive link between project performance and reported profitability, making it accessible to managers familiar with accounting conventions. It is particularly useful when profitability ratios drive internal performance metrics or external reporting requirements. Strengths and advantages. ARR's simplicity and compatibility with financial statements make it a practical tool for internal reporting and communication. It aligns with conventional accounting frameworks, facilitating comparison with existing return on investment (ROI) benchmarks. ARR highlights the long-term profitability of a project rather than short-term liquidity, complementing the payback method. It also considers the full project lifespan, including post-recovery periods. Furthermore, ARR supports managerial control by integrating depreciation and accounting policies, linking capital budgeting decisions with profit planning and performance evaluation. Because it expresses results as a percentage, ARR enables straightforward comparisons across projects or departments with differing investment sizes. Weaknesses and limitations. Despite its accessibility, ARR suffers from several shortcomings. It ignores the time value of money, treating future accounting profits as equally valuable. Using accounting profits instead of cash flows introduces distortion, as profits are subject to non-cash adjustments like depreciation, accruals, and provisions. ARR is also sensitive to accounting policies and assumptions, such as depreciation methods or inventory valuation. Furthermore, it does not adequately capture project risk or cash flow timing. Two projects with identical ARR figures might have vastly different cash flow profiles and risk levels. Therefore, ARR's focus on accounting measures limits its usefulness in rigorous financial decision-making, making it better suited for secondary analysis rather than primary evaluation. Appropriate usage. ARR is appropriate for organizations prioritizing reported profitability or managerial performance based on accounting returns. It suits industries with stable cash flow patterns and limited inflationary effects, where accounting profits approximate economic reality. ARR may also be used for internal reporting to compare project returns with corporate hurdle rates or cost of capital benchmarks. While not ideal for high-risk or cash-intensive industries, it can supplement NPV and IRR analysis by providing a profitability perspective consistent with financial statements. ARR simplicity also makes it useful for initial project screening in small or medium-sized enterprises. Comparison with other methods. Compared to payback, ARR considers the full project lifespan and profitability but ignores liquidity and risk timing. Against NPV and IRR, ARR is inferior because it lacks time value adjustment and cash flow realism. However, its ease of use and compatibility with accounting systems make it appealing for managerial communication. When used in conjunction with discounted methods, ARR provides a complementary view, translating financial outcomes into profit-based metrics that resonate with stakeholders focused on accounting returns. In practice, ARR bridges the gap between financial accounting and capital budgeting. Role and prioritization. ARR can assist in prioritizing projects when capital rationing exists and profitability thresholds are applied. Projects with ARR above the target hurdle rate are considered acceptable, while those below are rejected. However, when comparing mutually exclusive investments, ARR may yield misleading rankings if accounting profit timing differs significantly. To mitigate this, decision-makers often use ARR as one of several appraisal tools, ensuring consistency with NPV and strategic considerations. Although less precise, ARR remains useful for communicating expected profitability and aligning investment choices with performance reporting systems.